All right, well, welcome back with Steve here again. And it's been about a month since our last conversation, and it's safe to say a lot has happened since then. We're not interested in commenting on the most recent headline or being prisoners of the moment. But I do kind of want to get a sense, Steve, for what is kind of capturing your attention in the context of the portfolio management when there is this volatility or rush of uncertainty.
Yeah. Well, I think there's been a lot of uncertainty from tariffs to just the price declines obviously in the market, and then you have the bond auctions and what's going on in different financial areas under the plumbing underneath the market. So there's a lot of moving pieces, and it creates a lot of emotions and certainly a lot of headlines. But in that, kind of the way I think about it, certainly we are well aware, and we spend time looking at the macroeconomics and the tariffs, and how they may or may not play out, if certain areas and industries get hit differently over time, or exposure to China. We're very well aware of that. But the thing that's captured me the most is as this emotion and uncertainty has gone up, just the level of volatility that's entered into the market. And
Mm,
we've been in a slowdown already coming into this year a little bit. Things were probably a little in certain areas of the market stretched on a valuation basis. So
hmm
really where I focus most of my time as prices did come down in different areas is where we're seeing opportunity now start to surface. And I think we're in the early innings of some of this opportunity really being uncovered, but we are seeing opportunity, and that's where we've really been digging in, is the different areas of the market that probably are, I don't want to say immune. There's lots of changes going on, but they're not in quite as headline an area necessarily. And so we can see whether it's in the biotech space and healthcare, or insurance area of healthcare, or other areas that have been hit pretty good, but has some of it has very little to do fundamentally with tariffs or a lot of the clickbait headlines. And so those are
hmm
the areas we're focused on all of it, looking through the valuations as opportunity comes, looking to rotate and put some dry powder to work. But yeah, it's some of the areas that you wouldn't think of that we're seeing some of the most value at the moment. So.
Yeah, it's interesting, good context, because when we have conversations, with clients that call in and maybe their account value is down, and a lot of times the conclusion of that conversation is to stay the course in some capacity, like stay, we're not going to abandon their goals just because there's a couple days of volatility. So and I think when we say that, we want them to remain invested, remain investors.
Sure.
And that doesn't mean that there's not changes happening in any given portfolio. So I guess what are maybe one or two things, and you don't have to be company specific here, but
Right.
what are you evaluating as you see a decline or volatility? Do you have a short list of companies that you're reevaluating? Are you looking to trim back on some things? I guess if you could give just a couple, yeah, a couple of bullet points there, would be great.
Yeah, so I mean, our general process is pretty straightforward. Whenever we have recent, declines or big fundamental shifts, or things that could create fundamental shifts in earnings, what we do is we model out, and I guess effectively we stress test all of the holdings, and we start to look through and we say, all right, if event A, B, or C happens, how will that affect our earnings in this company over the long term? And
Hmm.
so there might be a short-term model we run, and then a long-term model. And obviously, if something here, a holding we don't have, so I can mention it, would be like Nike shoes, right?
Okay.
And so Nike would be affected greatly in a scenario where tariffs go up a lot. They'll probably have to, if China tariffs stick, they're going to have to redo some of their distribution, supply chain, and so forth. And so there would be some real fundamental earnings changes, both short-term and long-term. And so we would go through, we'd stress test, we'd model that out, and then we'd see if there's opportunity during the volatility to capture some shares at lower prices that make sense and would deliver the return we want over the long run. And so that's what we do first, is we'd stress test it. But then we also have to take a step back and really ask ourselves, is anything really changing? And so without getting too specific, and this is not a buy sell in any way, but if you look at and you ask yourself 5 years from now, 10 years from now, is there still going to be demand for data at like Amazon Web Service or at Google Cloud or at Microsoft? Are people still going to use Microsoft 5 years from now in their businesses? And you start to ask those questions, and then you really start to say, has value changed that much over the last few months? Like, what has really ultimately changed the earnings and the cash flow of some of these businesses? And so when we start to look through it and you can chart out the demand, yes, there might be some temporary slowdowns in different areas. And, maybe people don't spend as much this year on their cloud business, so to speak. But we still see when we look at the fundamental demand, we know all these projects of building warehouses, projects of building data centers are still there. And we don't think that demand is going to change that much over the next 5 years, 10 years. And so when we look at businesses like that and we start to chart out the long-term cash flow that each one of those data centers is going to bring into the company, and we chart out, obviously inflation might go up. And so maybe it'll cost them a little more to build this, but this is how many they have. So you start working through all these numbers and then you can back your way into really the cash flow long term probably hasn't changed that much.
Hmm.
And so then the question is the value people are willing to pay for that business, has that materially changed? And in the short term, the answer is yes, if something's gone down a little bit. But in the long term, we know that over a long enough period of time, if the cash flow is there, if the earnings are growing in a very healthy way over a long time, eventually the stock price will also reflect that. And so we can look at those cash flows and we can discount them back today and we can say, what is a good fair value to pay, for this bucket of cash flows? How much are we willing to pay for the profits? Just like if we were to buy any business, whether it was buying a local business here wholly or whether it was investing in real estate, we would be very, very focused on what are the cash flows the business
Hmm.
is producing 5, 10, 15, 20 years of those cash flows. What does that look like? And what price are we willing to pay for those cash flows? And when you think through investing in those terms, not a lot has changed. While there is uncertainty over 6 months, maybe 12 months, the reality is if we own companies that are going to be around 20 plus years, 30 years, it hasn't changed. Like one little 6 month period of major cash flow changes isn't going to change a 30-year period valuation. And so that's what we're focused on, and that's what we're looking at as we sort through the landscape for opportunity at the moment.
That's really helpful, and I think gives some context and detail, like looking under the hood. In other words, people might get statements and just see a number, and this is what's kind of happening, on the rest of the pages of the statement. When you're trimming off a certain company or adding more to the portfolio, just positioning again for the long term. And as we zoom out a little bit, stepping away from those details, you really are kind of forced to reckon with what are your goals in investing. The goal for a 35 or 45-year-old is going to be different than someone that just retired and needs a certain amount of income coming out of their portfolio each month. So if you are categorically, still going to remain invested, that means that can we align those investments with your goals? And I think that is the key, and marrying those two concepts makes our job a little easier. And Steve, as the portfolio manager, appreciates the clarity and the goal as well.
Yeah, I
Uh,
think a good analogy we've shared before with a lot of clients is the idea of if you own a rental house and you're getting a really good income check from the renter there, and you go in each day and you're getting that check and nothing's changed, the value of the house probably doesn't matter as much in the short term to you. Unless you're
right.
going to sell the house, what you really care about is what's going on. Is the renter paying you the rent every month? And as long as that's happening and secure, then we're feeling pretty good. And that's kind of the way we view it. And we think at times like this, what happens, we own a whole bunch of these houses, let's say, all over, well diversified, collecting these rents. And what happens is, imagine you own your house here in Ohio, and the neighbors are out yelling in the yard, a hurricane's coming, a hurricane's coming. I mean, we kind of look at it and we're like, well, yeah, I mean, maybe, but is a hurricane really going to hit Ohio? I
Hmm.
mean, or maybe a big storm or a tornado? It's like people will get freaked out, but the probability in the long term of it changing what is happening is usually pretty low. And certainly that's why we diversify, because maybe that tornado does hit one house, but if we own 30, 40, 50 well-producing homes, then we're not as worried about that if they're well diversified in different areas. And so that's kind of, we just think people get over emotional. They yell out crazy things like a hurricane's coming in Ohio, or maybe they're yelling out legitimate things like, oh, there's a storm coming with a tornado. And it's like, yeah, there's a chance, that it does hit us, but we feel pretty secure in the fact that we own a lot of well-diversified companies. And if it does hit, and then we can reassess in the moment and take advantage maybe of opportunity. So that's kind of the way we view it. We think it's really important right now just to have our nose to the grind during these times and be aware of, certainly what's going on, use it to our advantage. But we're not going to get caught up in a lot of things we don't control. We'd rather just keep focusing on the earnings and the cash flow that each of our businesses we own produces. And if we think those are going to fundamentally change, over 10 plus years, then obviously we're going to make changes. Or if we see opportunity elsewhere, then we'll take advantage of that as best we can. But we will largely ignore a lot of the extra noise that we think isn't going to produce anything positive in the long term. So
Yeah, I think that's a good analogy, and just to add to that, it would be really hard to and say the storm is approaching and you try to go out and sell your house right then.
yeah,
It'd be nearly impossible. If the storm hits, that's okay. You assess the damage and you make improvements and you maybe sell in the future. So again, we're trying to eliminate some of the noise and just still look at the fundamentals. And Steve and his team do a great job with that. Well, I think that's a good place to end, Steve. Thanks again for your time, and look forward to the next conversation.
yeah, sounds great. Thanks, Dave.
Yep.
Take care.
Bye.